This video is intended for educational and informational purposes only and does not constitute tax, legal, or financial advice. Viewers should not rely on this content as a substitute for professional advice specific to their situation.
Hello everyone, this is John. Today I want to share something that can really make a difference in your financial life. Year-end tax planning for 2025. Most people only think about taxes when it's time to file in April, but by that point it's usually too late to change the outcome. The real opportunity to reduce your tax bill comes from planning ahead, before December 31st. And this year is especially important because of the One Big Beautiful Bill Act, or OBBBA, which brought major changes to deductions and tax rules. The steps you take now can affect not only this year's return, but your taxes for years to come. The first step in any year-end plan is to take a close look at your income for the year. By the time we reach the last quarter, most people can estimate where they'll end up. The key isn't just knowing how much you earned, but also comparing it to last year. If your income is higher, you need to be proactive. Employees should check their payroll, withholding to make sure enough tax is being taken out. Otherwise, you could face an unpleasant surprise in April, along with penalties for underpayment. Business owners, partners, and S-corporation shareholders should review their expenses carefully. Paying for things like rent, supplies, equipment, or marketing before year-end can lower taxable income. You can even accelerate some of next year's expenses into this year to reduce your tax bill. If your income is about the same as last year, your strategy doesn't need big changes, but it's still important to double-check your withholding and estimated tax payments to make sure you're on track. On the other hand, if your income is lower, that can actually be an opportunity. A low-income year is a great time to consider a Roth conversion. By moving money from a traditional IRA into a Roth IRA, you'll pay tax at today's lower rates and set yourself up for tax-free withdrawals in the future. Once you've reviewed income, the next area to focus on is retirement contributions. Always make sure to maximize retirement contributions before putting money into a regular brokerage account, because retirement accounts give you tax-deferred growth. That means you won't pay tax on interest, dividends, or gains until you withdraw the money. In contrast, a regular brokerage account is taxed every year, and that adds up over time. For 2025, the contribution limits are as follows. With a 401k or 403b, you can put in $23,500, plus another $7,500 if you're age 50 or older. If you're between ages 60 and 63, there's a special higher catch-up contribution of $11,250. Simple IRAs allow $16,500 plus a $3,500 catch-up if you're over 50, or $5,250 for those ages 60 to 63. Traditional and Roth IRAs allow $7,000, with an extra $1,000 if you're 50 or older, and you have until April 15th of 2026 to make those contributions. But all other plans must be funded by December 31st, or the opportunity is gone. If you're age 73 or older, don't forget about required minimum distributions. You must withdraw by December 31st each year, or you'll face a penalty equal to 25% of the amount you should have taken out. In the first year you turn 73, you can delay your withdrawal until April 1st of the following year, but that means you'll end up taking 2 withdrawals in the same year. Now let's talk about deductions. From 2025 through 2029, the deduction cap for state and local taxes, known as SALT, is temporarily raised to $40,000 for joint filers and $20,000 for married filing separately. High earners may face phase-down rules, but everyone is guaranteed at least $10,000. This means it may make sense to pay property taxes or state-estimated taxes before year-end to maximize the deduction. Beginning in 2026, itemized deductions for higher earners will once again be reduced by a formula, which means this year is the last chance to get the full value. And also starting in 2026, charitable contributions will only be deductible if they exceed 0.5% of your adjusted gross income. In 2025, there's no such flaw. So, if you plan to give, this is the year to bunch donations together. Bunching means grouping several years' worth of deductions into a single year, so that your total exceeds the standard deduction. That way, you can itemize in one year, and then use the standard deduction the next year. This creates long-term savings. There are several tools to make bunching easier. A donor-advised fund allows you to contribute a large amount in 1 year and take the deduction right away, while distributing the funds to charities gradually over time. You can also schedule medical expenses in a single year to meet the 7.5% AGI threshold, and you can time state and local tax payments before December 31st to claim them in the same year. With higher SALT limits and no deduction, phase-outs or AGI floors yet in place, 2025 is the best year to bunch deductions. Investments are another key area of year-end planning. Managing gains and losses in your brokerage accounts can help reduce taxes while keeping your long-term plan on track. One strategy is tax loss harvesting, which means selling investments that have lost value to offset gains. This can feel difficult, especially if you believe the stock will rebound. The wash sale rule prevents you from selling a stock at a loss and then buying it back within 30 days, but you can avoid this by waiting and purchasing after 30 days. Another strategy is capital gain harvesting. In a low-income year, you may be in the 0% or 15% long-term capital gains bracket. That's a great opportunity to sell appreciated assets and pay little to no tax on the gains. And since the wash sale rule doesn't apply to gains, you can sell and immediately repurchase the same stock, which raises your cost basis and reduces taxes in the future. Another way to save taxes is through a qualified charitable distribution. If you're 70 and a half or older, you can donate directly from your IRA to a charity. In 2025, the limit is $108,000 per person, and this counts toward your required distribution, while also keeping the money out of your taxable income. The OBBBA law also introduced some temporary new deductions for 2025. If you're 65 or older, you can take an additional $6,000 deduction or $12,000 for joint filers. There's also a new deduction of up to $25,000 for tip income and another up to $25,000 for overtime pay or $12,500 if you're single. It's very important to make sure your W-2 correctly reports tips and overtime, so you can claim these deductions. Finally, there's a deduction of up to $10,000 for auto loan, interest on vehicles assembled in the U.S. with a first lien, as long as the car is for personal use. In addition to everything we've covered, there are a few other essentials to review before year-end. Health savings accounts, or HSAs, are among the most powerful savings tools available because they give you triple tax benefits. Contributions are deductible, growth is tax-free, and withdrawals for medical expenses are also tax-free. For 2025, the limits are $4,300 for individuals and $8,550 for families, plus $1,000 if you're 55 or older. Contributions can be made until April 15th of 2026, but it's smart to fund them earlier if you can. Flexible spending accounts, or FSAs, are another area to watch. Unlike HSAs, FSAs are generally use-it-or-lose-it accounts. If you don't spend the money by year-end, it's forfeited unless your employer offers a grace period or a small carryover. So make sure to schedule any medical or childcare expenses before December 31st, if you have leftover funds. And finally, don't overlook the annual gift tax exclusion. In 2025, you can give up to $19,000 per person, or $38,000 as a couple, without affecting your lifetime exemption. This is a smart way to transfer wealth to children or grandchildren and shift future growth into their lower tax brackets. So to wrap things up, remember that tax savings don't come from filing, they come from planning. With the OBBBA changes, 2025 is full of unique opportunities that won't last. Review your income, maximize retirement contributions, check your RMDs, consider Roth conversions, bunch your deductions, manage your investments, and don't forget HSAs, FSAs, and gifts. Taxes are reduced with planning, not hindsight. And 2025 is your chance, don't let it pass you by. Thank you for watching, and if you found this helpful, please like, subscribe, and share. And as always, consult with your CPA or financial advisor to create a plan that fits your unique situation.